Continued volatility in the markets means some companies might be selling below their intrinsic value, but won't deliver returns until after 2 or 3 years. Let's bring in Jonathan Boyer. He's principal of the Boyer Value Group and host of The World According to Boyer. We want to know what the world's like according to Boyer. Looking at where the market is right now, obviously with the S&P 500, we saw levels we haven't seen in terms of the pullback earlier this week. A lot of the market action focused on Europe over the last few days, but how are you looking at all of these moves connecting the dots?
Listen, I think what investors need to do is take it as a stock-by-stock basis. The bottom line is there are a lot of stocks that are unbelievably cheap. Could they get cheaper? Absolutely. But if you look outside the real mega cap, let's say the top 5 names in the S&P 500, there's a lot of bargains out there. The S&P 500 equal weighted index is selling below what it was in March of 2020, and I don't think we have March of 2020 problems.
So we'll get into some of those specific names in just a bit, but a lot of investors are looking at their portfolio over the last few weeks saying, I don't know that I want to make any moves. Is this a time to cash out? Do I put things on hold? It sounds like you're saying, look past all the noise. There's a lot of opportunities to get in right now.
Listen, I wouldn't jump in with both feet right now, but it's a great opportunity for long-term patient investors who can withstand the short-term volatility. I think a measured approach is warranted, but I don't think it's a time to bail, assuming you're in the right stocks. I mean, there are a lot of stocks that are down 70-80% from their highs that are never coming back. But there are a lot of other stocks that are just great businesses that just have been, sold indiscriminately.
So let's talk about some of those stocks you're liking, starting with the financial space. 2 big names.
Yeah, the financials I think are a great place to be, especially with rising interest rates. The 2 we like a lot are Bank of America and Chubb. I mean, Chubb gains $1 billion of income for every 1% increase in interest rates. They should be doing really well. It's a hard market as well for insurance. Bank of America is the most rate sensitive bank out there. So there's a lot to like, and especially for a stock like Bank of America, it's sold off from 50 to 30. It's trading at a modest multiple of book, and people are thinking, recession, March 2008, and the same thing's going to happen. And this is a very different bank than it was in March of 2008.
Yeah, why Bank of America more than some of the other banks? Because of the interest rate sensitivity?
The interest rate sensitivity, I think it's probably one of the best run banks out there. They have a responsible, growth program. They're just done a great job in reducing the risk. They pays a nice dividend, and there's a lot less problems. You can get cheaper banks, but sometimes you get what you pay for.
Okay, moving on here into some of these other names. You've got one tech company at least in there, in Cisco. What do you like there?
Well, it's more of the old tech company. It's trading, I think, 14 times earnings or so. It's going more towards a subscription model. Get a good yield while you wait. It's just a solid balance sheet company. It's going to do well on the other side. And, if I was going to own tech, this is one of the names I'd want to own.
How do you differentiate between some of these names? And what we keep hearing is, sure, I mean, it sounds like you're looking at valuation more than anything, but the growth stories in many ways for at least the big tech companies are still intact. Mm-hmm. And we've seen a bit of a pullback, which seems to signal some opportunity there. But Cisco, yes, more of a legacy company. Mm-hmm. Why that over, for example, a company like Apple?
Apple is... Apple's is a difficult one. I'm not sure if I have a differentiated opinion on a name like that, but I think over the long run, a company like Cisco that's trading at a lot less, lower multiple. I mean, Apple is trading at a pretty rich multiple, so you're paying a lot, and with interest rates rising, there could be a lot of pain there just on multiple compression. So it's something I would be very wary of. I'm not saying you should sell Apple, but I'd rather buy some cheaper stocks like Cisco that are good, high-quality businesses that are growing, that have great balance sheets, that'll be around and over the coming years.
Another name we don't always talk about on this show, Hanes Brands. That's one of the ones that you say is actually a good buy right now. What do you like there? Yeah,
it's a good, not a great business. It's trading at 5 times earnings. It's a stable business. It's going to be there in 2 or 3 years. You're getting, I think, paid 8% while you wait. If the stock stays this cheap for a long period of time, a competitor will probably buy them, or private equity. So there's a lot to like. I think your margin of safety is quite strong there, and it's something that if you have the patience, it's worth looking at.
Finally, we've heard the word diversification over and over in this environment. We talked about some of those stock names that you like, but in terms of the overall portfolio, Is it still important to stay overweight equities? We've heard a lot of investors saying bond yields aren't looking so bad right now when you consider the returns you can get.
I think that's a case-by-case basis. It depends. Right now, that you can get 10-year treasuries is giving you a good return, but not after you're taking into account inflation. So I think it depends on your own financial situation on what you should do. If you're a young person who has a risk, a high risk tolerance and obviously a long runway, I mean, I would be extremely overweight equities, but as I said, I wouldn't jump in with both feet. I take a measured approach and buy a little bit at a time.
Yeah, caution, the way to go.
Caution is the way to go, but not too cautious.